Welcome to today's teachings. If this is your first time of visiting this channel, please do well to subscribe, and if you have been watching or following us for some time now and you have not subscribed, please subscribe to this channel. It's actually free. It's not going to cost you anything, and it won't take more than 5 seconds of your time. Ensure to turn on the notification bell as well to get notified once we upload new content, and we upload new content every week. We upload at least once in a week and every weekend. So on every weekend you should expect a new video from us. This lesson we are going to be covering implementing economic calendar events with the open. Someone actually made a request for a video on my last video. He requested for the New York open, London open, New York close, London close, New York highs, London highs. So I decided to add it to this video. I decided to add what he requested for the lesson. I decided to bring everything together. So what we are going to actually look at in this video, we are going to look at implementing economic calendar events with the open. We are going to look at New York and London kill zones, times of the day for high probability setup with power of 3. I'm actually, at the end of this video, I'm actually going to show us how to implement the economic calendar, how to make use of the economic calendar. I'm going to share with us the where I track my my fundamental analysis, the economic calendar that I work with. I'm going to share my personal one that I work with. Just stay till the end of the video and I'm going to share that with us. So with that said, let's get down to today's business. So now this is Australia USD, and I know I haven't really talked much on futures market, but I promise us I'm going to make a video on futures market. I'm going to talk about futures market. We actually started with the futures market, but now for some time now I've been talking about forex, just forex only. I'm going to do a video and I'm going to talk about futures market. Actually, I'm planning on doing a weekly outlook video, where I'll analyze different pairs. I'll just share my thoughts on how I expect the week to play out. So I'm just going to share my own personal opinion, and remember, it's not I'm not giving you signals, I'm just sharing my personal preferences. So I'm going to do a video on every weekend and analyze some pairs on different asset class. I'm going to look at futures, I'm going to look at crypto, I'm going to look at forex, and I'm going to share my personal preferences with everyone. So that you can see that I don't trade everything at the same time, but maybe lucky enough I might really talk about an asset class that you are interested in. So please, once again, subscribe. It's free. It won't take much of your time. That's the only way you encourage me, because I'm putting out time and resources in making these videos. So please support us and subscribe to this channel if you have not done so. So let's get started. This is the Australia USD on the weekly time frame. Remember, we always do an analysis from the weekly time frame, right? So this is the naked chart, naked price action data. So you might want to pause the videos and do your own annotations, and let's see if we can arrive at the same point, at the same point of view. So you can just pause the video, pull up your chart, and do your annotations. Let's share our thoughts. So let's get done. Now this is the weekly chart. So apparently we are very much bullish on the weekly chart on Australia USD. Okay, we just reached for this fair value gaps, right? We reached for this fair value gaps and price is retracing. So I'm looking at this as a retracement into this trading range. Okay, into this trading range. Okay, so I'm still having strong feelings, or how am I going to put it, I'm still having self some self confidence that Australia USD might likely reach up for these relatively equal highs. Okay, we have relatively equal highs. Ignore the weeks. Okay, you know this weeks here is kind of a kind of manipulation. Extra long weeks actually as a result of manipulations. Okay, so when we see in a scenario with of having long weeks, we view that as uh, manipulation. Okay, so you can see the body of these candles and these candles are relatively equal. So what is resting above here is buy side liquidity, right? So Australia USD might likely reach up for these relatively equal highs for the buy side liquidity resting above here. Okay, and we are still very much bullish because um we broke structure, right? And we have reached for a premium array. We have reached for a fair value gap. Remember price move from a level of discount to premium, right? Price moves from a level of discount to premium. In other words, if price trades from a certain level of discount, as we can see here, and reach for the opposite liquidity resting in premium, it will definitely reach back into discounts. Okay, so this is a retracement on the weekly time frame, and as you can see, currently we are already in the discount sector of this whole range. Okay, we're already in discounts, and some few facts I am seeing here are these two down close candles before this up move. These are weekly order block, right? These are weekly order block in a discount markets environment, and as you can see, we have this swing low right here. This is a low that has a higher low to the left side and a higher low to the right side. So what is resting below this is sell side liquidity, right? So I'm viewing this swing low as an internal range liquidity. Okay, so between this range low and this range high, I'm viewing this as internal range liquidity. So price is likely reaching for one of two things, right? Price is either reaching for an imbalance or is reaching for liquidity. And with that said, also combined with the fact that this swing low is resting below the 50% level, is in a discount market. Okay, so smart money might likely buy this or they might likely pump in more money to continue the trend upwards. Okay, I might be wrong, it might just continue going down, but I'm just giving myself the possibilities of the Australia USD resuming its uptrend. Okay, so that's just my personal opinion on it. Now looking further at this weekly range from a daily time frame perspective. Okay, so now this is that weekly range low and the weekly range high. Okay, I mean this high and this low, right? So this is the weekly range low and the weekly range high. Okay, now if we take a close look at, if we measuring our weekly range low to the high, we have our weekly equilibrium right here. Okay, and as you can see, price has already reached into the below the weekly equilibrium. At the same time, what is this two down close candles right here? This is an order block, right? This last two candles before this up move is an order block, and at the same time we are having a fair value gap at the equilibrium. Okay, so and as well we are having the internal range liquidity that is resting below this old swing low. So price, what is price actually reaching for? Price is reaching for, as we know, imbalance and liquidity. Okay, so this might likely move up from this level, or it might reach for the internal range liquidity and resume its uptrend. Okay, remember I told you when I said in my last video, when we have a buy program, okay, in this example we're having a buy program. So when we have a buy program, we expect all time frame to be in sync. In other words, if we are having a buy program, as you can see here, the weekly time frame should be bullish and the daily time frame should be bullish as well. Okay, but in this example, we are having a bullish weekly time frame and a bearish daily time frame, so one has to get in sync with the other, right, to correct the movement. Okay, so one has to be in sync with the other. So I'm looking at this whole move as a retracement inside of this range. Okay, I'm looking at this whole move as a retracement, and prices, as we learned, is reaching for one of two things, right? It's reaching for the a fair value gap or the liquidity. And as you can see, this fair value gap is at the weekly equilibrium, right? So we have the fair value gap close to a weekly equilibrium. We have a daily order blocks right here, okay, and we have an internal range liquidity. So this is what is likely drawing price downwards. So my bias on the daily time frame, focused on the sell side, because the daily is still retracing, is still correcting the move. Okay, it's still retracing, and I'm going to stick with that, and I'm still bearing in mind my overall trend move, which is bullish until the market says otherwise. Okay, until the market says otherwise. So I'm expecting one of these two time frame to get in sync with the other. Okay, I'm expecting either the weekly time frame to change its direction to be bearish, to change its trend, or the daily time frame to correct itself to go higher. Okay, so I'm expecting this fair value gap, a possible resumption of the uptrend from this fair value gap, because we are already in the discount sector. Okay, or it might likely reach lower for this internal range liquidity. Okay, and resume the uptrend. Okay, so but I'm giving myself room. I'm still sticking with this bias. Let's see how on Mondays goes. Okay, let's see how on Monday goes. I don't normally trade on Monday. I start my trading from on Tuesday. Okay, so now looking at it from the daily time frame perspective. Okay, looking at it from the daily time frame perspective, this is the current trading range we are in on the daily time frame. Okay, we have the low and the high. Okay, so now taking our fib from the bodies, remember this is just manipulation. This long wicks, whenever you come across the situation of long wicks that are long, we view it as manipulation. Smart money really pays attention to the bodies of the candles. Okay, so that's why you see I took my measurement from the body instead of the wicks. Okay, so now looking at the daily range, look at the range we are currently trading in. Okay, from this low to this high, we have our equilibrium, right? So price reached for an opposing liquidity and has already retraced back into this range, right? So right now we have this fair value gap. We have this fair value gap. We have this discount fair value gap. We are below equilibrium. Okay, we are in the discount sector, and we have this order blocks, right? So price is currently trading at two things. It's trading in a daily order block and inside, and filling at the same time filling the fair value gap below equilibrium. Okay, so this market can be bought upwards by smart money. Okay, money can be pumped in on this market, or they could easily allow it to reach for this weekly internal range liquidity, just like I mentioned earlier. Okay, but I'm still sticking with my bias. I'm sticking with my buy program, but being caution on the retracement that is happening on the weekly time frame, so on the daily time frame, sorry, because price moves in waves. Viewing this from this low to this high is one price. We view it as a one price movement, like, right? We view it as one price movement. As you can see here, price just moved up. There was no much of correction. In other words, there was no much of retracement, and price reached for an opposing liquidity. So price have to it has to correct the movement, so which is what is currently doing right now. So this is the correction move. This is the retracement inside of this range. Okay, so measuring our range, we expect to buy this market back from the discount section, and price has already dipped into the discount sector of the range, right? And right now we are trading close to a weekly order block. Okay, the open, we are trading close to a weekly order block, and price might likely reach for the open of the weekly order block and resume the trend higher. Okay, so I'm bearing in mind my overall trend on the weekly time frame, and also keeping in mind my trend on the daily time frame. Okay, so I'm conscious of those two time frames. Okay, so now let's get down to today's business. So prior to what I mentioned earlier, someone requested the video on session highs and session lows. Okay, so I'm actually going to be honest with you guys right now. I don't really pay much attention to previous session highs and lows of the previous day. Okay, I don't the fact is that I haven't really implemented those concepts in trading, in my own trading. Okay, when I'm trading, I don't really uh pay attention to the previous days London session, London's open, London's high. Okay, so what I'm going to do right now is that I'm going to share my own personal preference that I do. Okay, how I look and apply uh, I trade my kill zones. Okay, during my kill zones I'm going to share with you instead. Okay, so the question you asked was actually how I should make a video on London session highs, London sessions low, New York high, New York open, and the rest. Okay, well, so I'm actually going to show you now how I trade my sessions, how I apply my sessions. Okay, so now we have the New York Open. So what is the importance of the 12 a.m. midnight? Okay, the importance of the 12 a.m. midnight is that once you have your bias in mind, in this example, we are in this given price action data, we are bearish. Okay, we are bearish. So once you have your bias in mind, okay, the importance of the 12 a.m. midnight is that you are looking to sell, right? So you are going to be framing your sell setups. Okay, your sell setups, you are going to be framing it above the opening price or the opening candle or that's open up the New York sorry uh the 12 a.m. midnight. Okay, in other words, your high probability setup will be formed above the opening price on the 12 a.m. midnight. Okay, so which is that is why is this is the reason the 12 a.m. is very important. Okay, if you are able to get your bias, your high probability setup is always formed above the opening candle, because the once we what we have here is the diagram of what I'm trying to explain. Okay, so your high probability setup would be for sell days, for bearish days, your high probability setup will be above the opening candle. Okay, so the opening candle, what you do with the 12 a.m. midnight, you delineate the 12 a.m. midnight, you delineate your 2 a.m. New York time London session opening to 5 o'clock New York time. That is the time for the New York key zone. Okay, I'm going to explain what key zone means. So and the time for your New York key zone is 7 a.m. New York time to 11 o'clock a.m. New York time. Okay, so now the importance of the 12 a.m. midnight is that once we have our bias, once we determine your directional bias, your high probability setup is found at the opening candle or opening price, at the 12 a.m. opening price. So if, for example, the power of 3 is that if we are anticipating a bearish days, what you should see rather is the market should open at 12 a.m. midnight New York time and trade upwards first. The 12 a.m. midnight is that once you have your directional bias, in this case we are looking for sales. Okay, let's say you are able to determine your directional bias, and you know your bias is bearish. Okay, so applying the power of 3 to the 12 a.m. 12 o'clock a.m. New York time is that once the days open, once the candle that opened up the 12 a.m., you place a trend line on it, like as you can see here. Okay, and you draw it out in time. Okay, you draw it out in time. So your high probability setup for sales will be above the opening candle. Okay, so this is the manipulation. This is the manipulation. Some traders will be long here. Okay, they will be chasing this move, but you will be looking for your sales above the opening candle. Okay, so that is how important the 12 a.m. midnight is. Then for bullish days, in other words, when you are anticipating higher prices, when you are anticipating the day to be bullish, your probabilities, your high probability setup will be to look for your buy setups below the opening candle 12 a.m. the opening price 12 a.m. midnight. Okay, in this example, we are bearish, and we are looking for a sell scenario. Okay, so our high probability setup will be formed, or rather found, is found above the opening candle, the opening price 12 a.m. midnight. Okay, now talking about key zones, the London key zone is between 2 a.m. to 5 o'clock a.m. Okay, New York time. Remember, this is New York time. Okay, if you are to easily get the time, okay, you should use trading view and set your time to New York local time, to New York local time. That way you will get the time easily. Okay, it will be your default time zone. Okay, you set your platform to New York time. Okay, so now what Q zone actually means is that this is the time of the day we start hunting for our setup. Okay, we start hunting for our high probability setup. So your high probability setup for your London key zone is between 2 to 5. Once it is outside of once price is outside the key zone, you we stop looking for entries, or we stop looking for setups. Okay, so we frame our high probability setups between 2 to 5, and I'm going to show you why once we get to the application of the economic events. Okay, and once we get there, I'm going to explain why it is so. Okay, so what our key zone actually means is that this is the time window where we hunt for our setups. Okay, once we are outside, we stop hunting. Once we are outside the key zone, we stop hunting for our price, for setups. Okay, for entries rather, we stop hunting for entries. Okay, so your New York key zone will be between 7 a.m. to 11 a.m. So between this time window, you are expected to have to already have an entry. Okay, or in other words, you are expected to have been inside, to have an entry already. Okay, so to have a setup rather. Okay, so now coming back, stressing this again, the 12 a.m. midnight is important because once you have your directional bias, it makes it easier, it makes it easier to spot setups depending on the bias you are having. Okay, in other words, if you are expecting a sell day, if you are expecting a bearish day, your high probability setup will be above the opening price. Okay, will be found above the opening price, because this is the manipulation. This is when the high of the day is formed. Okay, so you will look to cash your entry during the time the high of the day is being formed. Okay, so and it will be vice versa for bullish days. For bullish days, your high probability buy setup will be below the opening price. Okay, the opening price New York time, okay, will be below the opening price. So this is when you are looking to cash your buy setups during the time the low of the day is being formed. Okay, so and key zone, the key zone are like the time window of the day we look for our setups. Okay, we look for our entries once we have our buyers in mind, and we'll go into our key zones to look for our entry. Once time is outside of these key zones, we stop looking for entries. Okay, we stop looking for entries. I will wait for the next key zone. Okay, so I hope I'll be able to explain the concept clear. Okay, so now we are going to look at this price action. Our bias is basically bearish. Okay, so we are going to look for our entries on this move that went above this opening candle. Okay, so our high probability setup is above the opening price, 12 a.m. midnight. Okay, once you do, you bring out your trade line, you place it on the candle, and you draw it out in time. Okay, if your bias is bearish, your high probability setup for sales will be above the opening candle. Okay, the opening price. So you look for your setup and your entries there, combined with your key zones. Okay, combine with your key zone, which is New York 5 a.m. To New York 2 a.m. to 5 a.m. and New York 7 a.m. to 11 a.m. Once it is outside of your key zones, you stop looking for entries. Okay, so now let us go. At the same time, the same way you can place the opening price, you calibrate the opening price 12 a.m. midnight, you can as well calibrate the opening price of each session. Okay, you can put a fib, you can put a trend line on this New York 2 a.m. opening candle. Okay, the candle that opened up at 2 a.m. midnight, you can put 2 a.m. New York time, you can place a trend line on it and signify it as opening price. So, and once you have your bias, in this case we are having our a selling day. Okay, we are expecting a selling day, we are anticipating a bearish day, so our high probability setup will be above the opening price of the London session opening. Okay, so the same thing goes here. We can look for our setup above this London, or above this New York key zone open. So we can anticipate a false move above the opening to create the New York session high. Okay, and the London session high. Okay, so what you're actually doing is that you are hoping to cash your sell when by calibrating each session's opening out. You're actually looking to to frame your setups during the time of during when the high of the session is being formed on each one. Okay, on each different session. Okay, so if you frame your setup, let's say you frame your setup on this opening price. Okay, and you are anticipating bearish move, so your entry will be during the time the high of this session is being formed. Okay, so obviously this is the high of the London session and also the high of the day. Okay, so that is how you calibrate you can as well calibrate each session's opening. Okay, but the best one to use is the New York 12 a.m. midnight. Okay, so I hope I'll be able to make that clear like a crystal. Okay, so let us look at these price actions and see what we have here. Okay, so now this is the opening price, right? This is the opening price 12 a.m. midnight, and we are in the London key zone. Okay, we are in the London key zone. So what you do, once price trades into your London key zones, this is the candle that opened up the London key zones. Okay, so now we are anticipating two things. For price to go lower, we want to see a run on buy side liquidity. Okay, in other words, we want to see we want to see an old high be taken out. We want to see price trade aggressively into an old high, taking out the buy side liquidity. Okay, so in this scenario, what you have to do, once your session opens, you look for the first swing high. If you are anticipating lower prices, you look for your first swing high. Okay, so someone asked me a question actually, which of the swing highs do you look for? The very first one. Okay, the very first one after after each session opening. Okay, in this example, this is the candle that opened up the London key zone. Okay, and this is the first swing high. As you can see, this is the first swing high. Okay, so after this London session opening, so you should expect some run on the sell side liquidity resting above here. buy side liquidity resting above here, sorry, so which is what we have here. Okay, so we have our run up here. Once this happens, once we have the run on sell side, on buy side liquidity above an old swing high prior to the London session opening during our London key zone, then you can go down to your time frame, to your lower time frame, because we are anticipating a sell. Okay, we are anticipating a bearish day and we are looking for sell scenarios. Okay, so now once we have this, you drop down to your lower time frame and start hunting for your shift in structure to go lower. Okay, and remember, as you can see here, we are currently above the opening price, which makes this a high probability setup, which makes this a high probability setup, because coupled with the fact that we are above the opening price, we are in our London key zones, and a first swing high prior to the London session opening has been taken out. Okay, price has attacked the sell side liquidity, the buy side liquidity resting above this old high. Okay, so now I want to look at this little box area for our shift in structure. Okay, for our shift in structure. Now this is that old swing high. Okay, this is that first swing high prior to London session opening, and as you can see, we have a run. Price consolidated first. Okay, so price consolidated, created a kind of resistance. So and people, retail traders retail mindset traders will view this as a kind of resistance level, and they'll be placing more sales here. Okay, so we have buy stops, we have the buy stops of those that are as well resting above here. Okay, to join the trend upwards. Okay, so now, but as a smart money trader, we know that the price, the movement on a bearish day above the opening candle is the manipulation. Okay, so the real move is below the opening candle. Okay, the opening price 12 a.m. midnight. So in other words, the movement on bearish days, the movement above the opening price is the manipulation, is the first move. Okay, so that is where we look to sell. That's where we look to frame our sell entries. Okay, on a bullish days, the movement below the opening price is the manipulation, and that's where we look to buy. We look to buy at the end, at the low of the day. Okay, we look to cash our buy entries during that period. Okay, so now as you can see here, we have the run on sell side liquidity, right, or buy side liquidity, sorry. We have the run on buy side liquidity. Price kept on pressing higher. Okay, this is the 5-minute time frame. So what I normally do and how I determine my next lower time frame is by going down gradually. Okay, you can just drop down to a 5-minute chart, and you can just stay on the 5-minute chart and watch out for your shift in market structure. Okay, so this is the 5-minute chart. As you can see, obviously, this is the run on sales on buy side liquidity, and there was no shift in market structure, right? So we have this huge move, then we have this displacement, then we have this retracement, and shift in structure. Okay, so now if you take a look at this price action data, we actually have two entries here right now. Okay, we actually have two entries here. So remember, what we are actually looking for prior to each session opening is two things, right? We are looking for an old high. When we are hoping to go short, when we are looking to go short, we should see an old high prior to each session opening. In other words, if we have a bearish day, we are anticipating a bearish days. Okay, we will look for our setup above the opening price 12 a.m. midnight, right? Then now when we come to each session's opening, the London session opening, we are looking for one of two things. Okay, we are looking for an old high to get rid. Okay, to get ridded. We are looking for a kind of run on buy side liquidity, or we are looking for displacement. Okay, so in other words, if you don't see, when we look at maybe there was no buy side liquidity taken out, the next thing we anticipate is a displacement. Okay, so we should see one of two things happen. we should see either a run on liquidity or a displacement. Okay, so in this case we have two entries right here. Okay, so we have a displacement. Okay, we have a displacement. We have the price move trade lower aggressively and created a fair value gap. Okay, so this could have been our entry. Okay, this is our entry right here. So just in case you missed this, but the thing is that price has not shifted in structure yet, but we have this displacement right here. So this is more like a high risk entry. Okay, this is more like a high risk entry because price could just continue going up because price doesn't shift in structure. Okay, so we wait for our shift in structure, which is here. Okay, price traded, took out this old short-term low and created a fair value gap right here. Okay, created a fair value gap right here, and this is where we got in, and as you can see our stop loss above here. Okay, so always remember, prior to each session opening on our Q zones, we are looking for two things. We are looking for the run on liquidity or displacement. Okay, so now dropping even further to the 1 minute time frame. Okay, we have our 15-minute high, old high right here, and this is the run on it. Notice how the market kept pressing higher without taking out any of these old lows until we got here and price shifted lower. Okay, so now I want you to, this is the entry we had on the 5-minute chart. Okay, but we are now on the 1 minute chart. Okay, so before I will show us okay, so now as you can see here, price broke structure, right? Price shifted in structure and went down aggressively, then started retracing upwards. Okay, so now during the process of price retracing upwards, we have this fair value gap and this fair value gap. So the most of the time what I do to filter my fair value gaps, if I have a situation like this kind of huge displacement, okay, so this is just price being offered on the sell side only. This is liquidity void. Okay, this is liquidity void. Price was just being offered on the sell side, liquidity, so creating an imbalance. So what I normally do, I take out my fib and I measure the range. Okay, and I pay close attention to the fair value gap that is resting close or above the 50% level. Okay, so in this case, this is the first fair value gap on the above on the premium sector of this whole range. Okay, so this is where we got in. Okay, so this is where we got in, and we got in a little bit area compared to the 5-minute entry. Okay, we got in a little bit earlier compared to the 5-minute entry. So now what I want you to see next is this. What I want to bring to your notice is the fact that we have a failure swing right here. Okay, we have a failure swing right here. So we have this high formed and we have this low formed. We have this high failing to go above the low. Okay, creating a failure swing and price drop down. Okay, so remember we talked about swing points the other time. We talked about swing points in our previous videos, that once we have a higher time frame objective reached for, we should anticipate a swing high from, okay, one of the two swing high. We should anticipate a failure swing or a run on liquidity. Okay, in this example, in this case, we have a fair swing. Okay, we have this high formed, a low formed, and a high failing to go above the previous high, and this was sold on weakness. Okay, this was sold on weakness. So price created this displacement and we got our entry above the 50% level in the premium sector, because this is a huge displacement, right? So if you had used this as your entry, okay, your risk will be much more bigger compared to when you use this as your entry. Okay, but most of the time you can use this, okay, because your price might actually not reach for this one. Okay, so you can use your first fair value gap and your stop would be this swing high or this candles. Okay, so now as you can see, we got a nice entry right there. So going back higher to the 5-minute chart, we can see the same swing high form here. Okay, we had an high, sorry, the 5 minute chart, sorry. So this is the 5 minute chart. We had an high, a low formed, and another high failing to go above the previous high, okay, and dropping. So this was sold on weakness as well, okay. So you'll see how everything matched up, okay. So we have a swing point created here. So the swing point is more like it's more like giving us a first hand information on the turning around of this uptrend, okay. It is kind of signaling us that this current underlying trend has come to an end, okay. So that's just the meaning of swing points. They coming to an end of an underlying trend, okay. So this notified us that this trend is coming to an end, okay. So we have a low, we have a high, a low, and a fade high, a high failing to go above the previous high, and a displacement, okay. So and a shift in structure as well, okay. So now that is that for that. And we have similar thing here. We have a high, a low, a lower low, a lower high, a high that failed to go above the previous high, uh, and at the same time signifying that the trend that the trend is weak, okay. So this was sold on weakness, and our entry was right here. We got a nice one, okay. So that is your London key zone. That to hunt for your setup during your London key zone, okay. So let us take a look at our New York key zone, okay. This arrow is actually pointing to the candle that opened up the New York time, okay. Remember I talked about calibrating the opening price of each session, okay. So if we have calibrated our opening price of this New York session, of this New York key zone rather, if we had calibrated it and expected price to trade above it, to look for our entry, unlike the London session, okay, that price went above its opening, because this is the candle that opened up the London key zone, okay. If you calibrated that in time opening price, you can see that price went above it, okay. Price went above the opening candle, the opening price, okay. So but in this example, price failed to go above the opening price, okay. This is the candle that opened up the New York key zone, okay. So if we had calibrated that in time, we would have not been able to get any entry. But remember, we are still above the opening price 12 a.m. midnight, okay. So you see, this is why I advise you use the opening price 12 a.m. midnight, okay. You just have to be flexible with it, okay. You just have to be flexible with it, okay. Now remember, prior to each session, if we are anticipating lower prices, we want to see a run on liquidity, okay. We want to see a run on liquidity. But in this case, and what is the first swing high prior to London session New York key zone? Prior to London New York session opening, what is the first swing high? Probably this, okay. So we have a higher high, and so we have this swing high, okay. So in other words, we should have seen a run on the liquidity resting above this old swing high, okay. We should have seen a run on it, but that was not the case, okay. Instead, we got a break of structure to the downwards. We got displacement. So remember, I told you earlier that we are looking for one of two things, either a run on liquidity or displacement, okay. In this case, we have a displacement. We have an old short-term low being taken out, creating a huge displacement, okay. So what is this? This is our fair value gap. So we look, once price trades into this fair value gap, we draw it out, we will look for our entry right there, okay. And at the same time, we are still above the opening price and in our New York key zone, okay, in our New York key zone. So let's see. So this is our break of structure. Instead of getting a run on liquidity, which is obviously a run above this old high, we had a displacement, okay. We had a displacement. So let's say you miss your London session key zone, okay. So you are then looking for an opportunity on the New York key zone, okay. So this is your, you saw something like this, okay. So remember, we are bearish, and we are looking for old highs to get taken out. The first swing high prior to New York opening, okay, which is obviously this. So we are expecting a kind of run on the buy side liquidity resting above this old high, but instead we had a breakdown. Okay, we had a breakdown. So when you see a scenario like this, okay, this is a displacement. Okay, so our entry will be once price trade backs into the fair value gap, and our stop loss will be above this old high. Okay, so now let's go down to the lower time frame and look for our entry. Okay, so this was the New York session opening. Okay, and we had a huge displacement, breaking structure to the downside. Okay, created a fair value gap, and price traded. So you would have been in right here. Okay, if you didn't wait for, let's say you didn't wait for a structure market shift in structure, but I always advise, okay, if you wait for a shift in structure and the swing points to be created. Okay, so we have this, and we have this run down, we have this movement upwards. Okay, we have this created, and as you can see, there was no much of a breakdown. Although we had a shift in structure right here, right, we have a shift in structure, but look at this, there was no much of a fair value gap created. Okay, there was no much of fair value gap created. So we have price consolidating, went up, traded into the fair value gap again, traded downwards, but there was no shift in structure. Traded up, traded downwards, traded above this, traded up again, and shifted in structure, right? So we look into this price leg from this high to this low for if there's a fair value gap created, and we have one here, right? So this would have been our entry. Okay, this is our entry. Our stop loss is above the third candles, or above the swing high. Okay, so now that is just how it goes. Okay, that is just how it goes. So a quick recap on what we have learned so far. I know this was not actually what you requested for, but the thing is that I haven't really tried the ICT concept is broad and it's wide. Okay, so there are those that frame their setup on London sessions, highs, open, and the rest. Okay, so this is just how I do my own trading, how I apply mine. Okay, so the importance of the New York 12 a.m. midnight opens that once you have determined your bias, okay, the manipulation is always above or below the opening price 12 a.m. midnight. Okay, depending on your bias. Okay, if you are having a bearish bias, okay, you should be anticipating to look for your setup above the opening price. Okay, then if you're having a bullish bias, you should anticipate to look for your setup below the opening price. Okay, so I hope I'll be able to answer your question, and I hope this helps. Okay, so please, if this is your first time of coming to this channel, please subscribe. Okay, the numbers of viewers that have not subscribed to this channel is still very large. Okay, the numbers is still very large compared to those that have subscribed. So it's free, and that's the only way to show appreciation for this content. Okay, so until we see next time, have a good trading week and a good weekend actually. Okay, so see you guys later. Thank you for joining us today.